Everyone, it's 4 o'clock now. I can see a lot of people are tuning in. This is another episode that we need to go through today. It's actually one of those events that we have been doing nearly every month, and this is the last one that we are going to do this year. So primarily it's just to educate each other around property investments. And you can get prepared to start if you can grab a cup of coffee, because I tell you there's a lot of information that we need to share if you are choosing property as a vehicle to actually prepare for your future and for your family and have a better retirement. There are so many investment strategies out there, but for me, this is one of the investment strategies that has changed my life and my family's life. I never knew I was going to be in this space until I started investing. But again, without knowledge, without knowing what we are doing, sometimes it's very, very daunting, and it is very easy to actually make mistakes. So again, guys, thank you very much everyone that has made this time on a Saturday when you're supposed to be spending that special time with your family, because we always work Monday to Friday and always weekends. Sorry, Sunday today. Always weekends are those days when you actually want to rest. So I applaud you by taking this action to actually attend. So today is me presenting, as well as Jones Akuesson from Supavest. So Jones is a senior business development manager from Supavest. And I am going to present first, and then Jones is actually going to present second. Now, because it's a very busy session, guys, I would encourage you to to write questions in the question and answer segment. And then we will have time to go through all those questions. I presume the chat box is not working, but if you can write your questions in the question and answer segment, or which other way, that's okay. So we'll go through those questions one by one at the end. So yeah, let us get started. I know some people are coming through, but that's okay. They will actually join us as we go. And I presume you can see my screen. And I'm going to share my screen with everyone here. Thumbs up if you can all see my screen, please, so I know everyone is actually on the same page. Excellent. Okay. So today's topic is about the property market outlook for 2025. So why are we talking about this? Because we can't change the past, we can only change the future. 2024 was, of course, a very good year for those that take risks, but those that are willing to take calculated risks. We made a lot of progress, a lot of purchases around actually Australia-wide. Despite the gloom and everything else that people are talking about, the high interest rates, the inflation, it's as if the world is actually coming to the end. But unfortunately, many people live in the social media era where people listen to the television and all the social media stuff. And people do not want to do anything until they hear anything positive. But for us and our clients, we rely on data, we rely on information that is actually on the ground to be able to make these calculated decisions and actually continue investing. Unfortunately, there's no right or wrong time to invest. as long as you can be able to borrow money and be able to buy appreciating assets, there's really no time to actually wait. Because the problem is when you hear the good news, you are anywhere behind the market, you are actually left out. So I encourage you guys, if you didn't do anything in 2024, to actually plan and be able to start investing in 2025, because as I will show you, there's so many positives that are actually coming through. So these are the few things that we are going to discuss. Is insightful market predictions, property growth areas, opportunities, different property investment strategies that you have to brace yourself for 2025. And then I'll go through why 2025 will be a great year for property investors. So yeah, this is a very good way of actually preparing. I know everyone is now trying to be switched off towards Christmas and the New Year. But if I were you, this is the time to plan and say, how am I going to approach the next year? So the information that I'm providing here is of general nature only. It's not financial advice. So you need to seek professional advice because I do not know your individual circumstances. So a bit about me. Yeah, my name is Sanders, originally from Zimbabwe, migrated into Australia in 2004. And I've been working as a nurse throughout my life, but I've deviated into property investment with me, my family, and my wife. So I am a director and a founder of two profitable companies. The first one is the Msisa Property Consulting, and the second one is the Msisa Property Development. So the consulting one is where we help everyday Australian to invest in properties Australia-wide. So we cover every state except the Northern Territory for now, but we are planning to cover the entire country next year. And then the property developments part is where we do our own property developments as an investment strategy. So I work as a buyer's agent, as I said, and I help people acquire positively geared properties Australia-wide. So I have never been an advocate of negative gearing from day one, although it is actually promoted everywhere. I've managed to acquire 20 properties nationwide, and I continue to actually invest as we progress. And I am a property developer. I continue to develop properties. I continue to sell properties. So I don't only buy properties. I also sell properties worth millions of dollars. So this is the only thing that makes me prosperous. And as I moved from a nurse to a property investor, and now a property developer. I've also realized that education is actually power. You can't do anything without education. So I'm also educating people on property investments. And hence, I've started writing books. My first book was written in 2020. It's called the 10X Property System. It's about how you can buy 10 properties in 10 years and retire comfortably. This is a system that I actually used myself. And just recently, I've published my second book, The Self-Managed Super Fund Investment Secrets. This one is a comprehensive guide that, it teaches you how not only to invest in a property, but other asset class using your self-managed super fund. This is a very big subject. This is a very big topic that you really should be looking into and get access to this book. So this is the first book that was published in 2020, and this is the second book that just got published last month. So without wasting time, let us go into why we are here today. Why 2025 is the best year for property investments? So, as I said initially, we all have got jobs, but what I've learned in life is your job is your job, yes, but it is always temporal and it can end anytime. So while you are still employed, while you are earning a lot of money, this is the time to plan about how you actually use that money. I know I might be biased, but obviously we are talking about property today. But personally, I found that if you buy appreciating assets, if you buy properties that are well researched in well located areas, you are likely to retire well, without really thinking about your work all the time, because you need to start planning for retirement. Some people live their retirement planning into their 50s or late in the 60s, and sometimes it's actually too late to do these things. So these are the fundamentals that I use myself that actually help me invest. As I said before, yes, you can listen to the media, that's okay, but without research, without numbers, without really going onto the ground and knowing what's happening in every individual state, in every suburb, in every location, then investing just becomes a guessing game. And remember, we have got so many states in Australia, we've got so many cities, we've got so many towns. So all these areas perform differently. Not every state or area is actually the same. So you need to know where to actually invest every time. But there is continuous increase in property prices. We have been investing now for a long time, especially in places like Western Australia and Queensland, as well as New South Wales. Property values have never stopped going up despite all the negative sentiments. So I always get asked this question: when is the right time to invest? As we go through all this presentation, I've got tips that I'm going to be giving you. And unless you are attentive, you won't know if it's a tip or not. But tip number one that I've learned is that you have to invest in opposing whatever the mass does. So be fearful when everyone is greedy, and be greedy when everyone is actually fearful. So now everyone is actually fearful, and this is the time when I actually invest, and there's a number of reasons for that. There is likely fall in interest rates. The interest rates won't be remain high forever. Probably the first quarter of 2025 or the second quarter, interest rates will actually start coming down. And if this is what we are looking for, it will be too late then to invest, because everyone will know the news, and then everyone will start jumping on the bandwagon. So this is the time to actually starting investing. If you can afford a mortgage, don't worry about the interest rates. It is actually part of doing business. Australia is one of the democratic nations. You may agree or disagree with me, but I've been here for 20 years. I've seen so many prime ministers come and go, but nothing changes. The economy remains stable. It's one of the most stable economies in the entire world. So that's why I always want to put my money in this country. There is record migration that is coming through. In the next 5 years, we are close to 500,000 people that are going to come into Australia, because there's a lot of shortage of skilled labor. And most of these people that will come in, the first place that will go get the share of these migrants is Melbourne. So what then does that mean for those that are in Melbourne, or those that want to invest in Melbourne? Melbourne is one of those areas that is going to do so well in the next few years. The other states have been performing well, but for some reason, Melbourne has actually been silent. And the second share of those migrants will go into Sydney. And then number 3 will be Brisbane, and number 4 will be Perth. So guys, these are the demographics that are actually used to actually invest. So from next year, or once next year starts, we are going hard on investments in Melbourne. It doesn't mean that the other areas won't do well, but Melbourne is right at the bottom of the market right now, and is one of the states that will overperform all the other states. There's all rental increases are actually going up, which is a good thing for us investors. The reason for this is there isn't enough houses that are actually available, and all these people coming in, where are they going to rent? So where are they going to stay? So that's why rents will actually continue to increase, and there's not building enough housing that is actually happening, and skill shortage in the building industry. I am actually in the building industry myself. I am witnessing this a lot. That's why property values continue to rise. Australia is highly developed, and it is a growing economy. I think I don't need to tell you, wherever you live, whether you're in Melbourne, Sydney, Brisbane, or wherever, as you drive from today on, just look at the infrastructure that is actually being built, be it roads, hospitals, airports. There's a lot of stuff that is actually happening, and Australia remains a highly developed, and it is a growing economy. And government infrastructure, the government is spending a lot of money on a lot of infrastructure projects. And everywhere in the world, everyone wants a piece of Australia. So foreign investors always want to buy Australian real estate, because as you can see, if ever you bought your own home to live or an investment property, I've seen values of properties here going up anywhere between $100,000 to $200,000 within a space of 1 to 2 years. So this is the area to really, this is where we need to be. And bricks and mortar carry less risk. I can't overemphasize this. I know people are so scared borrowing money to buy property, but I always ask people, where is the risk? Because number one, yes, you are going to borrow money from the bank, but once you acquire that asset, then you actually hand it over to a tenant to go in the rent, they pay the mortgage for you. If there's a shortfall, yes, you can actually top up and then be able to invest. And most importantly, the banks are lending you the money anyway. That is what is actually fascinating. So, someone might say, okay, what is the difference then with someone who goes and buys a car for $100,000? Well, for me, there's more risk there, because once you drive that car out of the garage, you try and sell it tomorrow morning, it will be worth maybe 80,000. So you are buying a depreciating asset, whereas bricks and mortar will always appreciate in value. So there's really less risk in investing. So I can talk on and on why 2025 is going to be a very good year, but let us look at state by state now. If I had my money today, which states and which areas would I be investing on? So again, these areas change depending on what is actually happening on the ground. And I may mention some cities or areas to invest. It doesn't mean that all the other areas are not good. It's just the areas that I've researched myself, and you need to do your own research. And most importantly, I think it is wiser to use professionals anyway to actually help you unless you know what you are doing. So let us start with New South Wales. Obviously, this is the state that overperforms with all other states, despite the fact that houses are expensive. Sydney and New South Wales in general, it will always overperform. It will always do well compared to other states because that's where the money is, and that's where people, even if someone was to come here and they want to live here, they always hear about Sydney. This is where they'll probably land anyway before they start migrating to other areas. So there's Shellhaven. I love that part of the South Coast. There's a number of things happening there. You know, there's the natural beauty that comes with it, and the lifestyle is quite good. Housing is affordable, and population growth is actually going to happen a lot up there. So if I had my dollar now, I'm actually investing so well in those areas. Again, Shorehaven covers a lot of areas up there, so you need to know where the money is. The second one is Aubrey Wodonga. This one is a border. It's actually it can be in Victoria or it can be part of New South Wales. So that's an area that you also need to look at. It has got affordable housing. It has got a diverse economy and is strong. It is a very strong property market. Tweed Heads or Tweedshire is in New South Wales. It's actually New South Wales, Queensland border. It has got very stunning beaches, strong infrastructure, and nice cafes and restaurants. So those things that you don't consider is actually one of the areas that are going to perform very well in 2025. Wollongong City, why? Because Wollongong is not far from Sydney itself. You can go there via train or by road. And it is still affordable compared to Sydney itself. It's a thriving economy, and it's especially tourism, and it is popular for people that it's a popular relocation destination. So people want to, they always want to move there, especially if you can't afford Sydney. And Lytton is someone who say, why would I put my money in Lytton? You know, for me, I'm looking at affordability. If I can't, there's no way I can spend money on a 1.5 million house. If you are on low budgets, guys, Lytton is one of those areas that we should consider. It's actually southern New South Wales. It's near Griffith. It's a very big agricultural hub. It has got a very stable economy. It is affordable. It has got a very low crime rate and a low vacancy rate. So someone might say, why did you leave all the other areas in Sydney, like Canterbury, Bankstown, you know, it could be Bayside or City of Parramatta or anything like that? That's okay. I've left those purposefully because I am not into negative gearing. If you can afford them, that's okay. You can actually do so. I'm just looking at areas that every one of us can actually afford. The next state to consider is Queensland. Queensland is one of those beautiful warm areas. The weather is always good. And right now, if I had my money, I would put my money in Gladstone. There's a lot of things happening there. And it will continue to outperform other areas. For the sake of time, I won't digest why we are investing there. Again, we need to do your own due diligence. And if you're not sure, we are here to help you. Toowoomba is one of the areas that will do quite well as well. And it's already shifting as we speak. Bundaberg, Kingaroy. So I've tried to choose at least 5 areas in every state. Again, there are areas that you can be investing within the city or within the CBD, like inner Brisbane, Redland City, or City of Ipswich. There's the inner north, there's Wynnum, there's so many areas as well, but I purposefully left those. I am more into these regional hotspots. I am more into the regional hot markets because these are the areas where you make your money because it's still very cheap, it's still affordable. The rents are quite good, and there's a lot of employment going in there, and that's where the population will actually move to, and hence it will push property prices. Now, the beautiful Victoria, as I said, it has been a silent beast for a while because of regulations that have been put in around freezing rental increases and introducing high land tax, but it won't last. People will still realize that Victoria is one of those areas to invest, especially starting into 2025. So again, as I said, Aubrey-Wodonga, it shares a border with New South Wales. City of Geelong will continue to perform, Greater Shepparton area, City of Ballarat, and Mildura. So again, I've chosen 5 regional hotspots. There could be other areas there, like the City of Melbourne, the City of Melton, City of Monash, there is the Mornington Peninsula, and yeah, there's so many areas, but for me, I get fascinated around these areas that are very affordable because I want every dollar to actually work for me. Then obviously we can't go away without talking about Western Australia. Is one of those markets that has really performed so well. Yeah, so my role is to do research. My role is to look at these areas where you can actually buy properties. The only way to make money is knowing that there are markets that are undervalued, markets that are underperforming, but with a potential, with a projection that in the next year or so, then property values will actually start going in. So you need to know those fundamentals. You need to know why that is so. So obviously we are looking at population growth. We are looking at infrastructure spending. We are looking at migration. Are people going to live there? Are people going to move in there? Okay. So we went into Western Australia early in 2020 before everyone realized. So this is how we actually make money for ourselves and for our clients. But the mistake we do is then we go in late once everyone has actually realized that the market, and you cannot make money in real estate this way. So I am talking about Victoria now. People say, well, Sanders, why are you telling me about Victoria? But next year I'll be sitting here and saying, guys, remember I was telling you about Victoria. Look what has actually happened here. So this is exactly what has happened with Western Australia. It is continuing performing very well because property values are still low. The market is it's not, it has actually slowed down a bit, but probably it's just due to getting into the festive season and also the uncertainties around what the interest rates will actually do in the next year. But because it is still affordable, and because it's one of those areas that pays well for wages, and there's a lot of fly-in and fly-out workers, the Perth will continue to perform in the next year. So seat of Perth, seat of Great Geraldton, seat of Stirling, seat of Banbury. There's a lot of areas that I have left purposefully, but those will be the top performers in 2025. And we can't leave our sister Adelaide. South Australia is one of those. It's a steady market and it continues to outperform other areas for a long time. And again, it's about affordability. And these are the areas that will perform well in 2025. Again, you just have like I can choose one of those areas, and there's maybe 20 areas that you can choose from in those single areas. And it is a very complex exercise because people just choose an area and think, oh yeah, this is what I am going to invest in the city of Playford. But then there are other things like you need to look at the crime rate. You need to look at what is happening in that particular area while you are actually investing there. Is there a chance that property values will go up in the next 10 years? What has been happening in the last 10 years? So there's a lot of data that you need to gather before you actually make a decision to say, I want to invest in these areas. So again, guys, work is simplified by us actually helping you getting to invest in these areas. And of course, we can't leave Tassie. Tasmania is one of those areas that people think is not worthwhile investing, but I know that market quite well. I have invested there myself. I have left Hobart purposefully. If I had my money, these are the two areas that I'll be investing in. Why? Because it's still affordable. It's only a 1.5 hour flight from Melbourne. You can also get there using the Spirit of Tasmania. So it's not, it's actually a very good market, and the rental returns are quite good and also diverse. So now let us look at the type of properties to invest in 2025. So you can see I'm trying to feed you with a lot of information. I don't have much time. I'll try my best to digest this and that. And we see if we can go through this. So obviously there's the traditional method that everyone uses, which is the traditional single or double story properties. And those that want to invest in super, there's the single part contract where you can now build a house where instead of a house and land package, it actually comes as a single contract. It hasn't been allowed for a while. Now you can actually do that. So this is really, really interesting for, I think Jones will actually touch on this when he does his presentation. This is why self-managed super funds are such a very good investment tool. So this is where you can invest your money in. Dual living properties. So dual living could be a house and a grand flat. It could mean two houses that are on a single title. So on the other side could be 3 bedrooms, on the other side could be 2 or 1 bedroom, but they are attached to each other. You can't sell them separately, but however, you can rent them to 2 individual tenants. So this is a very good way of actually investing. Why? Because it maximizes on your rental return. If one of the tenants vacates, you still have income coming from the other one. Co-living properties are becoming very popular. These could be boarding houses, rooming houses, or those that are very sophisticated. This is where people are putting their money in. Duplexes, I love them. Duplexes are either strata or Torrens titled. You can still rent them separately. You can also sell them separately. And this is a very good way if you are on a bigger budget. Like we are helping clients buy duplexes around between 800 to $1 million. you should be able to actually invest in this, and they are very, very, very good, and I love them. NDIS, NDIS is a big subject, but again, if you want more knowledge about this and you want to invest in an NDIS investment, it's actually very good. And again, we are going to touch on that when we talk about fractionalized investments. Not only can you do it if you have got a good budget, you can also do it, join this if you have got a very low, if your super balance is very low, or you have got cash sitting somewhere that you want to grow your money quickly. A group of units, understand me when I say a group of units. I personally will not advocate for people to buy units in a strata complex. I'll never do this for myself, and I'll never do this for my clients. Hence, I'll never buy a unit. But what I'm referring here is, imagine buying the whole complex. Let's say there's 4 units or 3 units or 5 units. You go there, you own them outright. You actually buy them yourself. And this is a very good, I can talk on this subject all day because there's so many ways you can, either maybe they need renovation, to increase the rent, to increase the yield, to increase the equity as well. And, you know, at the end, you can also sell them individually whenever you actually like. So group of units are a very good way of actually investing. Land banking is one of my favorite areas of investment. When I say land banking, maybe people are talking about looking at just buying a block of land and then waiting. For me, as a sophisticated investor, this is not what I mean here. What I mean by land banking is, say there's a house that is sitting on 1,000 square meters of land. I buy that house, it comes with the land, and the house might need a renovation, yes, and then I then go to rent it. But this is not why I'm doing it. I'll be knowing that potentially in the future, I'm going to build 1, 2, or 3 houses at the back. So I just wait the market to do whatever it does. But at the same time, I've got a tenant that is there, even if they don't cover all the mortgage. But I know that the money is actually in the appreciating asset, and then I get approvals, either sell it with the uplift, or go on to build and then you have multiple exit strategies. Or the other way of land banking is, when you buy unregistered land, when you know land is going to register in the next 2 years, you buy it now, you only put a 5 to 10% deposit, you then wait. And the chances are that by the time that land registers, it would have grown up significantly. And then you choose whether to keep the land, sell the land, build on it, or then you actually move on. So this is another very good investment strategy. But again, you need to know what you are doing. Commercial investments cannot be overemphasized. This is a very good investment strategy for cash flow. Yeah, so let me now talk about how we help investors for the next 5 minutes, because this is what people ask to say. Sanders, you always talk about this, but how really do you help people? So most of the people that we help are very busy professionals, maybe nurses, doctors, physiotherapists. It could be anyone that they want to concentrate with their day-to-day job, but they need someone who can actually help them invest professionally. They want someone who can help them minimize risk, and knowing that they are buying quality assets. So we look at instant equity investments. I've covered some of those. Self-managed super fund investments is our big core business, where we help people set up their SMSF. You know, we go through helping them acquire whatever asset they need to acquire. and all the way to making sure it is actually rented and linking them with the right professionals. We always want to invest in positive or neutral cash flow properties despite the high interest rates. We always are opposed to negative gearing unless you want us to do that. We always review your current situation and recommend suitable investment strategies. So at least you may sit there and think you can't do it, you can't invest, but unless someone talks to you and looks at your situation, you really never know. Assist and link you with relevant property professionals. So there's so many professionals that you have to have in a single transaction, from solicitors, conveyancers, you're looking at property managers, and everything that is needed there. We actually link you with those, including mortgage brokers. We do the property research and the due diligence, and most importantly, we help you acquire the asset. And this is really saving you time and money, because if you are doing it yourself, it might take you 6 months to a year versus something that can be done within a month. Your property investment buyers advocate. So we purchase properties nationwide, and we are there to advocate for our investors. We negotiate price, and we make sure that we get what you want. So it's a one-stop shop for property investments, and we help you grow your property portfolio faster. Everything is about minimizing risk, because you are not using a few dollars, you are borrowing bank money, and why wouldn't you use a professional for that? And the most powerful tool is the ongoing education and support. Most of the time, this is what we lack, and that's why we are educating each other now. So you can contact us using these platforms here. And you can also jump onto our website to look at what other people are doing. We have got a live page, a Facebook page. We have got a LinkedIn page where we post things that are happening. We post seminars. We post the deals that are being purchased. People talking about what's actually trending and what is happening in the market. So if you haven't already purchased the 2 books I was talking about, the 10X Property System, you can actually get it by scanning the QR code there. It comes in 3 forms. So it comes as an ebook, it comes as an audiobook, and it also comes as a hardcover. So it really depends which one you want. Obviously, for the ebook, it is free. But if you wanted the hardcover and the audiobook, then you have to order it online. But again, without education, sometimes we struggle a lot. Education is always power. So I hope, guys, you've been writing questions in the chat box. I am now going to introduce you to Jones to actually go through what he has to talk about, and continue writing questions in the chat box, because instead of confusing each other, we will then, once Jones finishes, we will then go through all the questions and possibly answer them. If we can't answer them, we'll always put you into the right perspective to see how best you can be assisted. So without wasting time, I will introduce, let me stop here. So Jones is a senior business and development manager from Supavest. We've been working together for a while, helping our clients invest in a lot of different investment strategies. But Jones is basically going to talk about fractionalized investments. And
Yes.
then we're going to learn on that. So over to you, John.
Thank you very much, Sanders. And thanks everyone for joining this webinar. It's an absolute pleasure to be here on this beautiful Sunday afternoon. And by the way, I have the Sanders books, and I couldn't recommend it enough that they're absolutely amazing. I've learned so much in those two books. So yeah, go ahead and please order your copies because they're great, absolutely great. So as Sanders mentioned, my name is Jones from Supavest. I'm going to share my screen right away. So give me one sec. Okay, I hope everyone can see that. Can you see my screen? Good. So again, thank you so much, Sanders, for having me. Supavest, this is the business I work for, and we're going to talk about TIC property, tenants in common, which is a fractional investment in high cash flow properties. Just a quick one, I'm not going to spend too much time on it. Quick disclaimer. So we're obviously not financial advisor. If you want any financial advice, please go ahead and seek any licensed financial planner to help you with your investment strategy. So who I am, Jones Akuesson. As you can hear, I still have a pretty strong French accent. So I was born and raised in France. My dad is from Benin, West Africa, and my mom is French with a Spanish background. And I came to this beautiful country back in 2016, so it's been close to 9 years now. And I've been working in the property space ever since. I'm absolutely passionate about property. I'm passionate about be able to work in this country and helping people to make the right decisions. So this is why there is a lot of synergies between Sanders and I, based on our passion when it comes to property investment and helping people. Supavest has been in a property business for now 5 years, and our mission is to allow people to build passive income and generational wealth by leveraging the superannuation to build new high yield properties across Australia. So the core of the business is be able to provide single part contract in high cash flow properties. So we take a two-part contract and we provide single-part contract for superannuation investors. And the main purpose is to be able to get access to, as I mentioned, high cash flow properties such as NDIS, co-living, rooming housing, dual keys, duplexes. We believe in high cash flow properties. And when it comes to self-managed super funds, we do believe that SMSF, self-managed super funds, is the most effective tax vehicle in the country. When you only pay 15% income tax, the best way to take advantage of this amazing tax structure is to be able to purchase high yield properties inside Super. So this is what we do, single part contract. Now, in this session, we're going to focus on a specific product that we have called, as I mentioned, TIC property. Okay, so I'm going to go through it. Again, if you have any question, please write them down. I'm going to answer to any questions by the end of the presentation. And again, if you need to have a private session or you need specific answer or you need to sit down with us, please reach out to Sanders. We work closely, and as you mentioned, we've been working together for a while now, and that's an absolute pleasure to be able to do business with Sanders. So what is TIC property? TIC property, TIC, stands for tenants in common. So tenants in common is an investment structure that has been in place in Australia since the 1800s. So that allows multiple investors to co-own property with specific ownership percentages. So what we do as a business, we source and we purchase high yield properties around the country. So those properties will be NDIS homes. Again, NDIS, it's a whole topic on its own. If you need to have specific answers, please book a time with us, and we'd be more than happy to go through it. So NDIS stands for National Disability Insurance Scheme. So we purchase NDIS properties and rooming houses. Rooming houses is a sort of co-living investment properties where you have different tenants. So NDIS homes and rooming house are probably on the top of the food chain when it comes to high yield options in residential properties. So this is why, as a business, we're trying to acquire those kind of options. So the way TIC property works is we purchase those properties, we own 65% of those investment properties, and we allow investors to purchase fractional investment, so to become co-owners. So there is 7 shares of 5% available in those properties. When it comes to how much a 5% cost, what you're looking at around from $60,000. So depending on the price of the property, you're looking at between $60,000 and $75,000. The return, the expected return on those kind of options will be up to 11% per year. Okay, and this will be paid monthly to every single investor. As you understood, this is cash only, so there is no loan required. TIC property can be purchased inside and outside superannuation. Even though we focusing on self-managed funds and investors, this specific product can be also purchased outside of superannuation. So who is this product for? Okay, so number one will be individuals with less than $250,000 in their superannuation who want to invest in high yield properties. Absolutely amazing for a younger demographic or anyone who came from overseas. For instance, in my case, I obviously walk the talk. So I came to this country, 8 years ago, a bit more than 8 years ago, but I didn't have the opportunity to contribute to my superannuation over the last 20 years. So for me, TIC property, it's absolutely amazing. So this is what I'm doing right now. I want to grow my super quicker. So I'm investing in those high yield properties. And that's the case for, most of our employees at Supavest. We all into it. Our family members are into it. Otherwise, we'll not, be promoting this product. Yeah, that's a absolutely unique solution. Number two will be individual with leftover funds in the superannuations. So working with senders, if you been working with senders, you might have purchased a property in the past inside your superannuation, and you have some leftover inside your super, where potentially you've been looking at purchasing shares or purchasing, crypto. But if your bias is into property, this is an amazing opportunity to be able to go ahead and keep investing in property. Now, if you have, so it could be the fact that you have a low budget inside your super, or you have some leftover, or sometimes it could be that, for whatever reason, you don't want to get a loan inside super. That could be also an amazing option for you. Number three will be individual with cash available outside of superannuation, seeking for interest-free property solutions. As I mentioned, anyone can purchase a share from those properties outside of superannuation. Again, if you prefer property than stocks or crypto, go ahead and purchase and own a fractional investment from those properties and become a co-owner. Benefits of TIC property. Again, you're purchasing in a high cash flow property. So when you're looking at the return, you're looking at between 8% and 11% yield per year. This income will be paid monthly. Okay, so you're looking at the annual income of those property divided by 12. This is how much you will get, whether inside or outside superannuation. Capital growth. You benefit as the property value rise. Okay, so we're talking about property. You get some capital growth, obviously, especially when you're looking at investing inside superannuation. It's a long-term investment. You're looking at the next 10 years, 20 years, 30 years, 40 years, and more eventually. So without any doubt, you know that most likely the property value will grow. So you can pick up the capital growth of those fractional investment. Title ownership. So this is a major one. Why? Because fractional investment, it's not new. Okay, it's very popular, especially in the States. Now, the way fractional investment works, especially in the States, is you purchase a share from a company, would then go ahead and purchase a property or a portfolio of property, or you purchase a unit from a unit trust. With TIC property, tenants in common, you own your fraction, which means you own a title. Okay, so if you buy 5% of a property, you own this 5%. This is very important. Okay, that, by the way, it doesn't have to be 5%. You can, there is 7 shares of 5% available on each of those properties, so you can go ahead and purchase, 2 shares, 3 shares, 4 shares, depending on what you want to do. Hassle-free management. So Supavest, as you understood, is the majority co-owner. So we will look after the management. So the goal for any investors is to be able to secure the share and without any, any worries about who's going to manage it. We're going to look after it for you. So we look after the property management. We look after, engaging the SD provider if it's an NDS property. So it's hassle-free management. Exit strategy. Yes, you can, because you own this fractional investment, you own your share, you can sell whenever you want. You do not have to get permission from any other investors. You're the owner of your share, so you can sell whenever you want. Now, because we are the majority investors, Supavest, we have what we call first right of refusal. So, which means that if someone wants to sell their share, we will most likely buy it from them based on the commercial valuation of the commercial value of the property. So just so you know, rooming house and NDIS will be commercially valued. So all our portfolio, all our property in our portfolio will be commercially valued every year. So the commercial valuation would take into consideration the high yield of the property. So regardless of how the market goes, the market of the region goes, most likely the commercial valuation will be higher than the actual purchase price of the whole property. So whenever any co-owner wants to get out and sell their share, what we will do is we will do a commercial valuation. We will do our own commercial valuation. The co-owner will do their own commercial valuation, and we will buy it from them based on the average price of those two valuations. I hope that makes sense. But yeah, an amazing exit strategy. Now, if the co-owner wants to sell it for more that the commercial valuation came, well, they can go ahead and do it, and they can sell it on the open market through a buyer's agent, such as Senders, or you can even sell it on domain and real estate. So yeah, great exit strategy for anyone who wants to go ahead with this investment. Now, with that being said, especially when it comes to self-managed super funds, my recommendation is to be able to keep it, as long as possible, to take advantage of the high yield options, of the high yield version of those NDS properties. And just to touch base on that, for anyone who have been looking at NDIS properties, again, it's not a topic of today, but I just want to clarify a couple of things. So we've been involved in the NDIS space for now 5 years, so we understand exactly how it works. And especially when we purchase those properties, because we own 65% of those properties, and we want to get advantage of the high yield of those options, we'll do what we call a participant-led model. So we work closely with SD providers. We understand where the demand is for NDIS properties and people with disabilities. And this is where we will source a suitable block of land, and a builder will do the best design possible for those kind of options. So those NDS options are very well sourced, and yeah, when it comes to income, there's nothing like this around the country. So now, when it comes to NDIS also, as you probably understood, there is a bit more to the build So it's all usually a bit more expensive. So if if you've been looking at purchasing NDS property in the past, you might have come across the roadblock of not being able to afford an NDS property. So this is an amazing way to be able to, with a lower amount and a lower deposit, to be able to own a fraction from those high yield options. So this is a quick example of the type of property we have available. Okay, so we have options a little bit all over the country, Western Australia, South Australia. So as you can see, we sold, I think, more than 20 properties now with tick properties, and we have a few properties still available. And that's what we do every day of the week. We source new options, and that's definitely our best product. So it's being it's being sold pretty well. So we're trying to get more options on our book as we speak. So that's the kind of option you can look at. So in terms of price for the 5%, you're looking at between $55,000 and $75,000. All depend on the actual price of the whole properties. This one, for instance, Alkimos, it's a dual key NDIS in Western Australia. Dual key NDIS for robust participants, so people with some disability that falls under the robust categories. Dual keys, absolutely amazing option for them because you have one tenant, one participant. So people under the NDIS space, we call them participants, people with disability. So you have one participant on each side with a nurse, an overnight carer. So they're on their own. They have both sides of the properties, and you can pick up the yield from the two participants. This one on the left in Winter Valley, Victoria, this is a rooming house. Okay, so you're looking at this one is a 5-bedroom. So 5-bedroom. So it's not really a bedroom, to be honest. It's more a studio. Like I call it studio. People in this space call it residencies because you have the bedroom, you have the bathroom, obviously, an ensuite, a living room, and also a kitchenette. Okay, in one space, in one studio. So it's a proper studio. And on top of that, you have a living room that being shared by the 5 tenants. So why rooming house? It's a high yield properties. Well, because you get 5 times the income for this property. So you have 5 people paying a rent between, depending on where it is, depending on the type of properties. But for this one, for instance, you're looking at $450 per week per studio. Okay, so you multiply this by 5 and by 52 the number of weeks during the year, and you're getting a very extremely well positively geared property. So NDIS, rooming house, 2 different type of investment options, but absolutely great when it comes to high yield and amazing for SMSF investors. I have some clients who wants to diversify, so you don't have to buy different. If you want to buy different shares, you can you can diversify. You can buy one share from an NDS property in Western Australia, one in a rooming house in Victoria, and maybe another one in South Australia. Let's move on to the process map. Okay, we're trying to make it easy for you when it comes to understanding how the whole process works. So this is the process map for an NDIS option. How it works, and again, I can't say it enough. If you need further information, at the end of this presentation, we have a QR code where you can book a time with Sanders. That will be Sanders most likely and myself, and we'll be able to answer any specific questions. Okay, so when it comes to the sales process, very simple. It's like any property purchase. You put down a sales advice with a 2,500 holding deposit. We issue the contract. You review the contract, your solicitor review the contract. If you're happy, go ahead, you sign the contract, pay the full amount of the tick share. The contract is being exchanged. And then from that point, most of those options are obviously house and land. We do have a few options. Most of those options actually close to the slab stage of the property. So they're going to get, the construction is going to get started anytime soon. But you're looking at house and land. So the land in some time need to settle. Then we have the NDS tenant sourcing starts, usually starts just before when the builder go on site. And then we have every stage as any normal build. So you have the slab stage, frame stage, lockup, fit out, and NDS practical completion. And then that's it. Once the property is completed, usually it takes 6 months, between 6 and 8 months for the house to be built. And once the house is completed, that's it. We go ahead, the tenant can move in, the participant can move in those properties, and you start getting your income from that point. Now, I wanted to take you through a real life scenario. Okay, so this is a projection we've done for one of our clients, and you might relate to their situation. Okay, so we've been talking to two partners, so a couple. The first partner is 58 years old, second one 57 years old. In that specific case, they wanted to go ahead full on with NDIS options and tick property without getting any loan. Okay, but you can also think of someone who have, who have purchased a property with Saunders, for instance, inside the super, and they have some leftovers, or they're looking to do it, and they know they're going to have a couple of hundred leftovers. Okay, that will work pretty much the same. In that case, those two investors wanted to invest all of their superannuation in tick property. Partner number one had an annual income of $460,000. Superannuation balance at 58, $275,000. Partner two, age 57, has an annual income of $90,000 and superannuation balance of $125,000. Now, if you run those numbers through the government website, moneysmart.gov.au, you can have an idea of how you're going to end up in retirement. So this is, real life scenario, we took this number from the government website, moneysmart.gov.au. And by the way, you can go ahead and do the same exercise for yourself. And I will show you how much you will have in super if you leave your money inside NGC super funds, okay? Without setting up an SMSF, you just let it go, leave your money, your funds inside NGC super funds. It will show you how you're going to end up at age 65, 67. So for this specific scenario, those two investors will end up, if they leave their money inside the NGC super fund, they will end up at age 67 with $756,000 inside superannuation. Now, how it works from that? Well, basically they will draw down their fund from the NGC super fund during their retirement life, okay, over the next 25, 30 years. In that specific case, it's been calculated until age 91 years old. So basically, they will draw down their fund from the NGC super fund. Now, $757,000, it's above the average. The average in Australia is $609,000. So the average couple end up at age 67 with around $690,000. So it's a bit above that. So you might think this is great, but if you look closely at this graph, you quickly understand that by age 91, they will have nothing left in their superannuation, which means that they won't have any technically any assets coming from their superannuation that they can leave on to their kids, grandkids, or loved ones. So that can be an issue. Now, as I mentioned, they will draw down from their superannuation, and this will represent an income per year of $87,000 per couple. So I don't know about you, but for me, I think it's a bit limited. Okay, when you're looking at, you've been working 40 years, 50 years, you might want to have an amazing lifestyle inside during retirement, which is my case. I want to be able to travel the world. I want to be able to take my wife back to Paris, once a year. be able to drive a nice car, have my grandkids over, have barbecues, go out for lunch and dinner. So $87,000 per year, it's a bit limited. And if you look closely at this graph, you can see that the government has to jump in. So the dark blue lines, it's the age pension. So that means the government has to jump in and contribute to the income. So they're still on a government pension. Okay, now let's have a look at another strategy. So same investors looking at eventually purchasing TIC property, fractional investment in high yield option with Sanders and Supavest. Without getting too much into details, basically what I'm trying to show here is they can purchase 6 shares today, okay, with what they have in Super, and they can purchase another few every other couple of years. So at 60, age 66, 67, they will have purchased 12 shares in TIC property, loan-free, just cash. The income that they will have at the retirement age at 65 years old will be $99,000 plus CPI growth. The asset value of those 12 5% shares will be $902,000. And because we're talking about passive income, obviously those shares generate some income. So they will, and when you set up an SMSF, you have a bank account obviously linked to your SMSF. So they will be collecting some passive income, some rent from those options. So at age 67, they will have $259,000 in their bank account. When you compare the two different strategies, well, for me, it's a no-brainer. When it comes to income, industry super funds, during their retirement life, they will have an income of $87,000, 508 per year. With TIC property, close to $100,000 per year. Assets, with industry super funds, they will start their life in retirement with $756,000. TIC property, it's also above that, so you have $900,000 in assets. Now, obviously one of the main difference, and I'm sure you guys understood that, is the asset in industry super funds will be used to have a lifestyle in retirement. Now, when you own properties, your lifestyle will come from the income of those properties. So you actually do not touch this $900,000 except if you want to sell it, because you just live out of the income of the other option. So the $99,000 come from those 12 TIC properties purchased. And guess what? The value of this property will grow over time. So not alone you just do not touch your assets, you actually grow your asset and you have a better lifestyle in retirement because your income is higher. Cash at bank and super funds, well, nothing. TIC property, $249,000, 640. So in any way you look at it, and again, this is my bias, this is what I believe in. In any way you look at it, be able to own high yield options in SMSF take you in a way better position in retirement when it comes to lifestyle and income, generally speaking, and lifestyle, generally speaking. Now, how do you get started? As I mentioned, I work closely with Sanders. I touch base on a couple of things here. Now, we're more than happy to go in further details and to explain and maybe to sit down and to see how does it look like for you when it comes to how much do you want to invest inside your self-managed super funds, how much funds left over do you have, how much fund do you have outside of super, or it could be both. I work with a few investors currently who wants to invest inside and outside super. So as we speak, actually, I catch up with them this week, and they want to buy 10% inside super and 10% outside super. Absolutely doable. So now, if you want to assess your own situation, please scan this QR code and book a time with Sanders. So at Supavest, we mostly work with B2B partners, so we B2B geared. So we work with financial advisors, buyers agents such as Sanders. So any question that you have, please go through Sanders, sit down with him. I'll be more than happy to join the catch up also, whatever it's a video call or face-to-face meeting, and we can assess your own situation and help you grow your superannuation quicker, invest in property, own some property, even if you have a lower super balance, and allow you to build passive income and generational wealth inside or outside super. I'm sure you have many questions. If you do, please send them now. And if you want to catch up and have a proper private session, please let us know, and we'd be more than happy to assist you. And that's about it.
Thank you very much, Jules. You did quite well. And
welcome.
Yeah, we have got loads and loads of questions that we need to go through. And I think we have got enough time because it's only 5:15. So yeah, it looks like people are really interested in a lot of stuff.
That's amazing.
So if you can bear with me, and then we go through the questions. Guys, as we progress, if you have got more questions, by all means put them in. We'll see if we can help you. So the first question is, City of Sterling, are you looking at Balga and Marabuka areas? The other suburbs in Sterling are very expensive, and I doubt that suits positive gearing strategy you talked about. Look, for me, this is for property education purposes. The reason why I chose that suburb is we've got clients that have got different price brackets in terms of purchases. Some people love negative gearing. Some people have got they are on higher salaries. They want to reduce the taxable income. So yeah, the City of Sterling is actually expensive, but there's some people that it's a very good capital growth area for the next few years if you can afford it, if you can waive the negative gearing for some reason. The second question is, what's wrong with buying units? This is interesting. I didn't say completely it's wrong to buy units, but for me as an investor, I always tell people I'll never buy a unit for myself and I'll never buy a unit for everyone else. But if this is what you can afford, units can be very cheap. They offer a very low entry point. However, the reason why I do not invest in units is because I believe that the land component is the one that grows in value more than the building itself. So that's why I want to buy houses on blocks of land. And also remember, units come in multiples. It could be 100 in a single complex. It could be 20. And these units come with pools, gyms. It could be tennis courts. They're strata titled, and there's really limited capital growth compared to when you purchase something that is on a block of land. But having said that, if that's what you can afford and it's your entry point level, that's okay. But personally, I wouldn't invest in units. What is the difference between paying for a strata in a block of units and paying for both corporate? Well, these are just words that are interchangeable. It's one or the other. It's just the same thing, really. There isn't any difference there. Roughly, how much should one aim for the cheapest but decent investment? Again, this is a very broad question. Number one, it depends with your circumstance, and it depends where you are looking, because every market has got different entry levels. But as a rule of thumb, generally for now, it will be very hard for you to find anything below 500 Of course, you can still do, but you really need to work harder to find that investment that will give you that capital growth prospects together with the rental yield that you want without really going into super regional areas, because I am not a fan of investing in super regional areas. So as a rule of thumb for now, if 500 is the only amount you can raise, I think you still have got a chance. But again, the property market continues to tick. That number will change soon. This one is specifically for you, Jones. What are the risks involved in TIC property investments? Obviously, with every investment, there is risk. So someone wants to know what the risks are.
Yeah, great questions. The risk. Okay. So when it comes to TIC property, you investing in a house and land, so a property that has to be built. So I guess the risk will be linked to any new build investment, the risk of the builder, going under, for instance. So to answer these questions, if the builder goes under, goes bankrupt, what we do is we have a home insurance all the way through the construction. So basically, we will finish the construction. We will just have to hire a different builder, to engage a different builder, and the home insurance will cover any cost that will occur to having a new builder jumping on board and completing the construction. I think that again that's a risk that comes with any house and land new build options. So this will be the main risk.
Okay, thank you for that. You stated that it is supposed to be a long-term investment. What is the minimum exit period? I presume this, if someone is going on to acquire the TIC investments and then they want to exit, I think they just want to know.
Yeah, sure. They can exit whenever they want. They own their share. They don't have to ask anyone. They can sell it whenever they want. It's like purchasing a property. A full property, you can exit whenever you want. There is no minimum time before someone can sell their share.
Yeah, the next question, I think you touched on this, but I think maybe the client missed it. Also, what is the minimum percentage to be invested?
Yeah, so that's 5%. The minimum is 5%. Every share would be 5%. So you see, it goes by unit of 5%. So that would be, if you want to buy one share, that would be 5%. That's the minimum. If you want to buy two shares, 10%, etc.
Right. Yeah, Jones, we are going to be busy, mate.
That's fine. That's fine. I have time. I have a bit of
what
water
happens
here.
when no participant or client is living in the NDIS property?
So as any investment, if there is no tenants, if you purchase an investment property, there is no tenant, there is no income. Now, when it comes to NDIS, as I mentioned, we do, because we understand this space extremely well, and we also purchasing those options for ourselves with the majority investors. So we want to get the high income coming toward our turnover, the turnover of the business. So we work closely with the SDA providers. The SD providers are the companies who look after putting tenants and looking after the tenant, the participant in those NDIS. So we work closely with NDS, those SDA providers. We have two main SDA providers partners, and I can give you some numbers. They have 95% of their properties tenanted. So I believe one of them has 250 properties around the country, the other one 150 properties around the country, and they have 95% of those property occupied. So they know exactly what we do. So before we go ahead and we purchase options, we do a participant-led model, which means that we will understand with the SD provider when they have tenants, when do they have participant, when do they have a demand for NDIS homes. And then from that point, when we understand which region, which suburbs need some NDS homes, we work backwards, and we will find a suitable block of land and we would engage the builder to design the best type of design for those NDIS homes. So we're extremely confident when it comes to getting tenants straight away in those options, in those properties.
Yeah, look, I really like it when people get involved and people ask questions,
Yeah, that's
because
great.
sometimes you may think the question that we are asking is not a good question, but this is the only way we can learn, guys, by asking those questions, and that's why we are providing these platforms so we can actually educate one another. The next one, it says, sorry, I got disturbed. I think it all marries to the question that we have just answered.
Yeah.
Sorry, I got
Yeah.
disturbed. What happens with NDIS houses if one of the rooms is not occupied?
Yeah, same. So the DSD provider will get another participant. So usually on those options, you're looking at two, or if it's a dual key, there is one participant per side. If it's a 3 bedrooms, you're looking at 2 participants plus an overnight carer, so you have 2 participants. And again, 2 participants is again very specific. I'm going to use some acronyms. 2 plus 1, that will be for HPS, so high physical support. We believe that 2, it's the like a good number. When it comes to robust category, we believe that only 1 participant will be suitable. So yeah, some options will have only 1 participant, or some option will have 2 participants if it's an HPS. If a participant end up, moving out, or you never know, like someone can pass away. So that would be the role of the SD provider to get new tenants, a new participant in that property. That's what they do. The SD provider, they only get paid when they have some participants. So that's what they do every day of the week. They speak to families, they speak to hospitals, they in touch with any providers in that space. They understand what they need, what kind of property do they need, and what they need them, and they start from scratch. Even they start from from the teenage age. Okay, so they will speak to family who have some teenagers. They're not yet on the NDIS scheme, but they will be on the NDIS, soon. So they know exactly how many participants they can have in a region. So that's the role of the SD provider. And again, we work with the best one in the country.
No, thank you. I'll try and answer this one.
Yes.
As a first home buyer, if I purchase a TIC property using my SMSF, do I still get the first home buyer's grant if I want to buy my personal property? So again, this is the beauty of getting into these fractionalized investments, because there's no loan involved. You don't have a loan on you, so no one really knows that you are doing this type of stuff. So if you are a first home buyer and you haven't purchased the property, and then you want to get into the first home buyer's grant, there is nothing that really stops you getting that, because practically you haven't bought a house, you haven't bought an investment, you didn't get a loan, so you can still qualify for the first home buyer's grant. The next question is, for the TIC, can ownership be transferred to beneficiaries such as children in the event of death, or co-owners? Well, we are getting into asset protection, and
Yes.
this is more of a solicitor's question.
Yes. Correct.
I think without really getting into that, that's where wills and come into effect. You have to seek advice from your lawyer, but I presume anything that you possess that you want to be passed on to your children, as long as that is tabulated and well documented in a will, I don't see anything wrong with that.
I agree with this answer.
Yeah. Is the SMSF text before I can use it for the TIS property? That's an accounting question. I mean, if you haven't invested in the TIC property itself, obviously depending on where your SMSF is actually sitting, it will be taxed at that 15% if you make money in the SMSF. But that is before you get into the TIS property investment. But then once you are in there and you make money, and then obviously that's when you actually get started
That's correct.
because once you start making money, you still have to pay tax.
That's correct. So you'll be taxed on the income. So most likely 15%
So
on the
it
income
goes
of
to the second, do I pay tax on returns? Yes. Do I replace the super over time? I'm not so sure what this is all about. Do I replace the super over time? So maybe they are saying that the money that is generated there, can they put it in their SMSF, which the answer is yes. I don't know if I got this question correct. Do we pay strata for the TIS property?
Do we pay strata? No, there is no strata you own. So obviously you share any expenses, but there is no strata because it's proper ownership. It's not, you do not, it's not like buying a unit from a building. You actually own the fraction of the property. So there is no strata involved. But there is expensive.
Yeah, because the property that you are buying, it is not strata titled anyway.
Correct,
So you are just buying
that's correct.
shares. So there's no way we can talk about
That's correct.
strata in
Yeah.
that. This one is, do you have a list of properties where people are exiting TIC so one could jump in? I don't think there are any people exiting once they go in. I don't know if that's your cup of tea. So I presume this person doesn't want to wait for something to be built, and then they are looking at the property that is already existing and they want to jump in now.
Correct. Well, we do not have anyone wants to exit, to be honest, at this stage. The closest option we have near completion would be, looking at 6 months, 6 months completion. Again, if you invest inside your super, I always emphasize the fact that you're looking at a long-term investment. It's not necessarily something you're trying to flip, especially a high cash flow property. You want to take advantage of the income. So, I believe the ideal strategy is looking at the long term, not necessarily trying to, buy it and sell it in 6 months. That might not be the best option for them based on my personal opinion. But yeah, that's 5-6 months. That's the closest we get from the property being completed and having the tenants moving in.
Yeah, the next one is a thank you, Jones and Sanders, for the fabulous presentation. Thank you for that. Is there any extra expenses to consider after buying the 5%, like maintenance, repairs,
Great question. So, as any investment properties, there is some expenses when it comes to maintenance and repairs. Those expenses will be taken out of the income, the high yield income. Okay, so let's say, I don't know, there is some plumbing to be done after a couple of years, and the plumbers. By the way, as I mentioned, we manage the actual property, so we'll be looking at getting the plumber inside the property, and then the plumber say, okay, yeah, whatever I've done, or the work I've done is worth $1,000. So the $1,000 will be just taken out of the income of the whole property based on the percentage you have. So if you have 5%, so you pay 5% of this $1,000, but that would be just taking out of the income. You don't have to put more money. The goal is to be able to leave your money there and just to receive the income of those properties.
Right, it's getting more and more interesting. What about when a tenant damages the property? This is when the insurance kicks in anyway. That's why we take insurance for the property in the first place. I don't know if you have anything to add on to that.
Well, what is so most of the time, okay. So the investors as responsible for any again, as any property investment, that will be the same. The investors are responsible. Now, in most of the cases, the SDA providers will look after the maintenance and they will pay the maintenance. Why? Because they want to make sure that the tenants will stay in the property as long as possible. So often this is what we see. Now, generally speaking, that's on the investors to be able to, get an insurance or to look after the actual maintenance of the property. And again, that will be shared throughout all the investors, and that will be taking out of the high yield income of those properties. Again, the goal is not to put more money in it. You're supposed to buy your shares and just to sit down and relax. So that will be taking out of the income of the property. And every fortnight, I believe, you have a report of how things going in the property, what kind of expenses we had to to look after, for instance. So yeah, that's I hope I answered the question.
Yeah, do you want to take a sip of water? Because I tell you, there's more stuff coming through. Do you allow one investor to buy the whole 35%? I
Yeah,
presume if yeah, you can, or you can simply buy your own NDIS property.
yeah, that's correct. So I didn't really touch base for too long on that, but what we do at Supavest and with you as a partner, Sanders, is we provide. Usually NDS come with two-part contract, okay, because it has to be built. So it's not doable inside Super because of the two-part contract regulation. Inside superannuation, you can only purchase single-part contract. So what we do at Supavest is we take the two-part contract and we provide single-part contract for SMSF investors. The reason why I'm saying that is if you want to buy a whole property, a whole NDS properties, and to buy a single part contract through us, you need to come up with 35% deposit. Okay, so just to take a round number, if the NDIS single part contract price is $1 million, and if you have $350,000, technically you can purchase a whole NDS property because you have the 35%. Now the remaining 65% will come from a loan. So if you're happy to get a loan and you want to own the whole NDIS and you have at least the $350,000, my recommendation would be go ahead and purchase a whole NDS property. Now, if you do not want to get a loan and you prefer the cheap property option, so you might want to purchase different shares from different property to diversify, or just put you all $350,000 inside one property for tick, yes, 100%. You can go ahead and purchase 7 shares of 5% and own the 35% of the property. In that case, that would be just cash, no loan involved. So yes, the short answer is yes.
Look, this is another interesting part of the SMSF or equity investments. I think in the next year we really need to focus. Maybe have we will have to arrange a webinar, simply a webinar that concentrates on single contract. Together with the NDIS, together with the rooming houses, so people can know, have a broader knowledge around how they can actually invest. Because this is where we lack a lot of knowledge, and people are actually doing so well in these spaces. But until it is hard to actually jump in.
Yeah, I agree. We can do it whenever you want, Sanders. Early next year we can do a webinar focusing on single part contract and high cash flow properties such as NDS and rooming house.
What about the tax income involved when receiving income from a rental? So obviously, when you receive that rental income, then because whether it's in a self-managed super fund or you're using your own money or equity, you still have to pay tax to the ATO. But if it's in a self-managed super fund, and then every financial year you need to pay at least 15% tax on the benefits that you have actually done, which is the lowest tax bracket anyway.
Correct. If I can quickly add something on this, is what I mentioned. SMSF, people really need to understand that. It's I'm really trying to emphasize this point. And SMSF is the most tax, in my opinion, SMSF is the most tax effective vehicle in the country for long-term investment. You only pay 15% income tax versus, you can pay up to 47% tax income, especially on the high yield options outside of super. So 57% versus 15%, it's a no-brainer. And most likely at retirement, you won't pay any tax. Outside of super, you keep paying tax until your last day on this planet, right? But inside super, only 15% on the income and then tax-free at retirement. So technically you can just live, you can have a lifestyle based on the income of those high yield options in retirement.
Yeah, so again, to expand on the other question that was actually asked, so whatever the rental yield you get from those high,
Yeah.
whatever the yield you get from that, you put it back into your SMSF. And then once it accumulates, you buy more shares. Or if it's more,
Correct.
you buy more properties. So
Correct.
what you are trying to do there is you are trying to grow your super quicker because believe me or not, if you leave it in the traditional super funds, there's no way you can grow money. I've seen people that have been in a super fund for 20 years and all they have is 200,000. And then you tell them, mate, how can you retire on 200K? Why don't you take that money, manage it yourself and actually grow it? This is what we are actually trying to do here.
Yes.
Yeah. Would I pay 15% tax on the TI's property rental income? I think we have already touched
Yeah.
that.
Yeah.
Now, with the TI's property, assuming I bought a share of 5% using my SMSF and property increases in value, then at the end of financial year, my 5% value would have documentation stating the value increase. If selling my 5% share are the only buyers allowed to buy my share, a part of the TISC only, meaning general public cannot participate in the sale of the 5%. I think
Yeah.
they are more worried about the exit
Yeah.
strategy
Yeah.
if
Yeah. Sure.
someone wants to
Yeah.
exit here.
I'm happy to answer this question. So I'm going to make it simple and take just an example, a scenario. Let's say you buy a 5%. Let's say the 5% is $60,000. Okay. In Australia, we say the property doubled every 7 to 10 years. Let's say in 10 years, just to take a number, in 10 years, you want to sell your 5%. So your $60,000 today will be, in this scenario, will be worth $120,000 in 10 years. So during this time, you will have accumulated some income from the property, and in 10 years, you want to sell it. Well, we will do, as I mentioned, a commercial valuation of the whole property, and then the commercial valuation will show that the property doubled in value. So your 5% will be worth $120,000. Supavest will buy it from you at $100,000. That will be the price, the value of your shares in 5 years. So basically, the value of the share depends on the valuation of the property, and yeah, so that's what it's about. TIC property. You pick up the yield, the rental income from the property, and also you pick up the capital growth whenever you want to sell your share, and you own a title all the way through. That's the three main benefits from TIC property. You own a title, you own a fraction of the property, pick up the high yield and the capital growth when you want to exit.
So again, this is a low risk strategy because
Yeah.
you are not on the loan. Two, you are buying 5 shares, which is totaling 50K or maybe 55 with all the costs. So, and then the other benefit is that we are pulling resources together with other investors. So when you look
Correct.
at it, your risk is really very, 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 very minimal.
Yeah, and to be fair, this is the only way in Australia to own some high yield properties with as low as $60,000. That's definitely that's a groundbreaking solution that we provide for investors.
Can foreigners invest in TIC? So
Can who? Sorry, what is it?
then foreigners, so those that are not Australian residents or
Oh yes, yes. So yes, great question. So TIC property is FIRB buyers approved. So you can, yeah, the answer is yes. You can live overseas, you can be from overseas, you can be a non-resident or non-citizen in Australia and live in Australia. You wanna purchase a TIC property, you can go ahead and do so. It's FIRB buyers approved.
I think we touched on this a bit, but someone wants to know any disadvantages to buying TIS properties, like any other investment.
Any disadvantages? I can't see many disadvantages. I can see um, I think that's a great question to ask. When you ask someone the disadvantage of the risk, honestly, I don't see many. To be honest, Well, the only it's not disadvantage, but it's a new product. Okay, it's new in Australia, so people don't understand how it works properly. But what I can say is we've been working very hard on it. Uh, with our lawyers, our team to make it work, and that's an amazing option. So I don't really see any disadvantage. The only thing I can say is, sh- sure, you do not leverage from a loan. Okay, if you wanna purchase a whole property, to go back to the example you give, someone who has $350,000 or 35% available, they can either purchase 7 shares from a tick property or go ahead and get a loan. Well, if you get a loan, you can leverage from a loan and own the whole property. I think that would be the only difference because you only use cash, you do not leverage from the loan. So I would say that can be some kind of disadvantage, but again, that depends on the situation, depend on where you are in life and what is your strategy. So yeah, it's a cash purchase.
Yeah, I mean, maybe the other disadvantage is that, unless you buy more shares, you are only buying, depending on the amount of money you have, you are only limited to buying 5 shares if you don't have enough money. Like if
5%. Yeah.
if only, yeah, you can only buy
Yeah,
five
correct.
percent
Yeah, sure. Yeah.
if you only have got 50K.
Yes, correct. Yeah,
Probably
yeah. Yeah,
that is the only disadvantage.
yeah,
But if you
sure.
can
Yeah.
afford more, then
Yeah,
yeah.
correct. Yeah, yeah, yeah.
So look, this has been one of those amazing presentations. I hope everyone has enjoyed. People have been engaging and asking questions. I think we have run out of questions right now. But again, guys, if ever you want to contact us, I think I gave you the link where you could potentially contact us. But like in every session, people take their time to come and attend these sessions with us. So today only, if ever anyone is ready to invest with us, the first 3 that will invest with us, we are actually giving a $250 discount on our consultation fees. How good is that? So what I mean by this is if you are ready to invest, you want to book a free 30 minutes consultation, by all means do so. But the $250 discount is only for the first 3. Otherwise, we'll sit down with you for those 30 minutes, analyze your situation, and look at what the best way you can proceed, either using your equity, using your super, or whether you want to look into the fractionalized investments. Other than that, Jones, this has been a very good event. I hope we continue to educate people as we
Yes.
progress. And for me, education
Yeah.
is power. I wouldn't be where I am today without education. And you
Yeah.
guys are lucky to be getting this free information. Some people are actually paying for
Yeah.
this type of this type of services. So
Yeah.
again,
Sure.
to everyone who has attended, we salute you. And, you have taken your busy schedule out of your Sunday. Please continue to do so. This is the only way you can prosper. This is the only way you can actually progress. My last saying is always, your job is not your job until you lose it. Okay. So you need to start planning about your future today. So yeah, I think for the sake of time and everything else, I think we have pretty much covered everything. Looks like there's more questions coming. Is there a minimum of TIC properties to buy to see financial benefits? I don't know what this
No.
is.
Yeah.
Is there a minimum of TIC properties to buy
The-
to see financial
Yeah.
benefits?
The minimum is 5%. So depending on the price of the property, we can add between $60,000 and $75,000. So that would be the minimum. And you have the benefit straight away because you're purchasing in high yield properties. So you're getting an income on proportionally based on how many percentage you have in the property. So yeah, even 5%, you're getting some income based on 5%, which is great because it's a high yield option, a high yield property.
Yeah, we have done so well. 10 minutes left, and that's fantastic. Thank you very much, guys. Look after yourselves. Enjoy the festive season. There is no webinar coming through next month as everyone is now switched off, preparing for the end of the year. It has been a fantastic year, and I promise you 2025 will be even a better year. Enjoy yourself, and most importantly, stay safe. Thank you then.
Thank you. Thank you, Sanders. Let's do it again.
Bye.
Bye-bye.